Does selling a losing investment actually help you save money on taxes, and how does Wealthsimple Invest make this work for you? For a long time, I heard about tax loss harvesting but thought it was some complex strategy only for the super rich or hedge funds. Then, I realized it's a completely legal and smart way to turn a portfolio dip into a tax advantage. I'm going to walk you through exactly what this opportunity is and how Wealthsimple Invest specifically helps you capture the best tax loss harvesting opportunities. Face with monocle, what is tax loss harvesting? In simple terms, tax loss harvesting is the process of selling investments that have dropped in value to generate a capital loss. You then use this realized loss to offset any capital gains you've made from selling profitable investments in the same year. This reduces your overall taxable income, which ultimately means a lower tax bill. The problem: when you sell a stock or ETF for a profit, that profit is a capital gain, and you pay tax on it. The solution: TLH, you sell a different investment for a loss. This loss cancels out the gain, reducing or eliminating the tax you owe. The caveat: you need to reinvest the proceeds immediately into a similar, but not identical, security to maintain your portfolio's desired market exposure. This is critical to avoid violating the wash sale rule. Direct hit the opportunity with Wealthsimple Invest. For the average investor, the most valuable part of using a platform like Wealthsimple Invest for tax loss harvesting is the automation. Doing this manually is a pain. You have to constantly monitor every security for a loss, check for an equivalent security to buy to avoid a wash sale, and track every transaction for tax season. Wealthsimple Invest, particularly for its premium and generation clients, turns this into a hands-off, algorithmic opportunity. 1. Automated, continuous harvesting. Manual tax loss harvesting often happens only at the end of the year. Wealthsimple's algorithm is constantly looking for opportunities year-round, which is a major advantage. If one of the underlying exchange-traded funds, ETFs, in your portfolio drops in price on a Tuesday in June, the system can automatically sell the losing ETF to realize the capital loss instantly by a different, similar ETF, one that tracks the same index or asset class but is not substantially identical, to ensure you stay invested in the market and avoid the wash sale rule. This discipline and frequency captures more opportunities than a human could feasibly manage. 2. Avoiding the wash sale rule. This is the biggest headache for manual tax loss harvesting. The IRS/CRA disallows a loss if you buy the same security or a substantially identical one 30 days before or after the sale. Wealthsimple's sophisticated software handles this by replacing the sold security with a highly correlated but different ETF. For example, if you sell a broad U.S. stock ETF that's down, it might automatically replace it with an ETF from a different provider that tracks the same index but has a different ticker and legal structure, thus avoiding the wash sale rule. This ensures the loss is valid for tax purposes while maintaining your portfolio's balance. 3. The tax alpha benefit. The money you save on taxes today isn't just money in your pocket, it's money that remains invested and compounding over time. They call this extra return due to tax efficiency tax alpha. When you use the loss to offset a gain, you defer paying tax on that gain. The money you would have paid to the government stays in your investment account, earning returns. Over decades, this deferred tax, compounded, can add up to a significant increase in your after-tax returns. Key best opportunities and when to use it: first-person experience. Based on my experience, tax loss harvesting with Wealthsimple Invest is most valuable and creates the best opportunities under a few specific conditions. Best time to start. You should consider enabling this if you meet 2 criteria. You have a non-registered, taxable account. Tax loss harvesting is irrelevant in registered accounts like RRSPs or TFSAs, as they are already tax-advantaged. You are a long-term investor who is currently realizing or expects to realize capital gains from selling other assets, or you have previously realized losses that you can now offset. The perfect storm opportunity. The biggest opportunities arise during volatile or declining market periods. When the market dips significantly, many of your holdings will have an unrealized loss. The algorithm quickly and automatically harvests these losses. I personally saw the most benefit during market corrections, selling an index ETF that was temporarily down, booking the loss, and instantly buying a similar one. When the market inevitably rebounded, my portfolio was still fully invested, but I now had a valuable capital loss on my tax return to offset previous gains. The key takeaway for you is this: you don't need to do anything. The opportunity is captured passively by the platform's technology, turning a market decline from a purely negative event into a financially productive one. With that said, thanks for watching, and until next time.